tokenization generally involves everyone in the market utilizing a shared ledger. If everyone can look to the same ledger in real time to see the information.
Tokenization, along with smart contracts, would allow the automation and increase efficiency of margin calculation and margin movements.
They can't cater for everything that could go wrong, and sometimes it's the thing you least expect that causes everything to blow up.
The standard debate between Bitcoin versus shitcoin, central bank digital currency, and what a terrible idea that is.
You had the option of opting out of the expense of complying with securities laws. You're going to consider it. And so what you can do is, slap a blockchain on your product.
Could you explain how something like steak or eggs could be represented by a digital token?
Can be recorded on a blockchain, and then the movement of that produce can be tracked using the blockchain across the supply chain.
But I have no provenance of that other than my grandfather's naked claim to that.
The tokenization of real-world assets is one such area that I'm particularly interested in getting into today. Because tokenizing real-world assets involves blockchains or distributed ledger technology, some might view tokenization as a mere extension of the digital asset conversation that we've been having in this committee for over a year. However, it deserves its own distinct conversation and prioritization. While digital assets are generally issued and managed on blockchain networks, tokenization can bring traditional finance, quote, on-chain. To put this in a different context, tokenization can leverage the efficiency and transparency of blockchains to help modernize U.S. markets. Today we welcome the testimony of Lilya Tessler. Ms. Tessler is a partner at Sidley in Austin, where she leads the FinTech and Blockchain group. Robert Morgan. Mr. Morgan is the CEO of USDF Consortium, a network of banks working to integrate tokenized bank deposits into the U.S. banking system. Nadine Chakar. Ms. Chakar is the global head of DTCC's Digital Assets at the Depository Trust and Clearing Corporation. Carlos Domingo. Carlos is the co-founder and CEO of Securitize. Securitize, or through its subsidiaries, is a registered broker-dealer, as well as operates an alternative trading system and transfer agent specializing in the tokenization of real-world assets. And Hilary Allen. Ms. Allen is a professor of law at the American University and Washington College of Law, where she researches the impact of new financial technologies. How does tokenization allow assets to be traded more freely and efficiently across these silos or walled gardens, and can this help bring liquidity and more marketability to something that's obviously illiquid and a very over-the-counter topic like art, for example?
Yeah, so tokenizing real-world assets offers markets the opportunity to leverage the capabilities of the blockchain that I discussed earlier. So tokenization generally involves everyone in the market utilizing a shared ledger. If everyone can look to the same ledger in real time to see the information, this eliminates the need to reconcile across multiple siloed ledgers. Intermediaries can use this same shared ledger to allow for two parties to transact with each other instantaneously using programmable smart contracts.
You were very involved, not you personally, but DTCC, very involved in the GameStop mania, where Robinhood, a publicly traded broker-dealer, woke up in the middle of the night trying to make margin, trying to calculate margin of what they had to post because of the GameStop trading mania on their platform. Could tokenization have made that analysis of determining what the margin call was for them more straightforward, more easy, so that instead of working all night and trying to have a conference call at 6 a.m. to post 9 or 10 a.m. Eastern Time margin? It seemed like there was a lot of mystery in that and a lot of back and forth. Would having it on a ledger have made that easier?
Well, I can't comment exactly on the specifics that you've described, but yes, one of the attributes that we believe.
So that would reduce fragility in that instance potentially.
One of the attributes we believe that tokenization, along with smart contracts, would allow the automation and increase efficiency of margin calculation and margin movement. So you will see an increase in velocity there. So we do believe that's one of the efficiencies to be able to deliver faster and more efficiently.
So there's some great efficiencies that we had here. But talk about some of the risks here, given the fact that we've seen the vulnerabilities in the blockchain sort of arrangement.
Thank you very much for that question. I mean, I think there's several gradations of risk. So, the worst case scenario to my mind is that tokenization, and this was raised by a Financial Times journalist, its primary function right now is to integrate traditional finance with crypto finance, because then we get all the volatility, all of the problems, all of the hacks, everything, having a direct way of influencing our traditional financial markets. And then if something goes wrong, it's not just those who chose to invest in crypto, it's everybody who suffers. But if you take the blockchain out of it and you keep this away from crypto, then as you say, there are a lot of benefits in terms of efficiencies, but there are also risks. A lot of the pre-programming makes things very efficient, but it also makes it rigid. And it means in unexpected circumstances, things can blow up. No computer programmer can think of all future states of the world. They can't cater for everything that could go wrong. And sometimes it's the thing you least expect that causes everything to blow up. So we should be mindful of that.
Thank the chairman for specifically scheduling a hearing that isn't about cryptocurrency. It isn't the standard debate between Bitcoin versus shitcoin and everything else in the cryptocurrency world. It's certainly not a hearing about central bank digital currency. And what a terrible idea that is. By all means, Mr. Lynch, continue to study it. Know and come to the conclusion that it is a terrible idea to implement a central bank digital currency, particularly the one currently conceived. In fact, this is a hearing about the rest of assets. What are we going to do about the whole rest of digital assets and how they might be tokenized to represent real-world assets? So thank you, Chairman, for having a hearing about the much broader part of the market. So could some of our witnesses address tokenized securities and some of the implications and opportunities there? Mr. Chakar.
Sure. Thank you, Congressman, for the question. To your point, it does require building an infrastructure that is interoperable, which will allow these tokens to move on different networks. And it does require that it starts with compliance as the underlying principle and build up from there. So we do believe it will become a network of blockchains. It's not one blockchain that will rule them all. There is technology today that allows us to incorporate compliance and rules and make a token a smart token that allows us to actually ensure that a lot of the compliance, AML, KYC sanctions.
But fundamentally, it definitely prevent the double spend problem.
Well, it does it from a perspective that you need a good control location, an entity like DTCC that's actually ensuring that these assets are encumbered, they're not being double spent, to ensure that the integrity and making sure that people have confidence in these tokens that are being. So that is why we keep saying it's the same asset, same risk, same principles, same regulation that will allow us to ensure security and trust in the system.
Professor Allen, in your written testimony, you mentioned that this provision in FIT 21 would be very attractive to issuers who seek to avoid SEC oversight, especially those for traditional securities. What would that mean for retail investors?
Well, I think, if you were a securities issuer and you had the option of opting out of the expense of complying with securities laws, you're going to consider it. And so what you can do is, slap a blockchain on your product, right? Even if it's not a particularly useful piece of technology, as you said, it can be quite useful in enabling you to get around a lot of the regulations. So, if the FIT 21 were to become law, that new Title II would basically allow you to slap a blockchain on any kind of investment contract, and therefore it becomes magically exempted from the securities laws.
In your testimony, you highlight food items as something that could be tokenized to enhance supply chain visibility. Could you explain how something like steak or eggs could be represented by a digital token?
So as I mentioned earlier, any asset can be tokenized, any real-world asset. So the location and authenticity of any produce, so an egg in your example, can be recorded on a blockchain, and then the movement of that produce can be tracked using the blockchain across the supply chain. So different participants on that supply chain can have access to a shared ledger of information to know at any point in time where that asset is. That same information, assuming it's a a commodity that's tokenized could then integrate into commodities markets and can trade, and anyone can buy and sell those assets.
I use as an example, my grandfather 30 years ago gave me a cane. That cane supposedly was given to him by Cordell Hull, former Secretary of State. But I have no provenance of that other than my grandfather's naked claim to that. How does that, in the real world, how do you connect that egg to the token that represents the egg?
So authenticity of and provenance can be tracked and traced and connected to the physical documentation that that you'd have in the traditional world would be linked to the blockchain information.
But subject to the same
subject to the same
potential
commercial
failures.
laws and local, state laws and others that are already in existence.
Can you briefly describe how the U.S. regulators have engaged with the Depository Trust and Clearing Corporation compared to overseas jurisdictions that seem to be moving ahead faster?
Thank you, Congressman. We're regulated by some 20 regulators around the world. And I do want to repeat my opening statement that we have one homogeneous market in the U.S., one post-trade. So we're a little bit ahead from our foreign competitors, if you will, that have a more fragmented environment. We have been working with our regulators on a variety of projects. And I'm going to tell you, it doesn't come without its challenges. But what we have been able to prove, that constant dialogue in working through the issues at a very granular level eventually leads to success. But it does take collaboration and cooperation on both ends.
Talk briefly about what you are building into your system that is not already in the permissionless public system?
Yeah, thank you for the question. USDF is building on private permission blockchain. Primarily because of existing regulatory guidance effectively prohibits banks from engaging in public permissionless networks. We believe that infrastructure exists in the same way that any other back-end ledger infrastructure will exist. There are a series of controls on top of that would exist in a traditional payment made today that are applied in the same way when it's done on a private permissioned ledger as well.
So at the end of the day, will you have a fully GAP-compliant system that would satisfy any Big Four auditor?
That's right.
Okay.
That is our belief.
My understanding is that any wallet on Ethereum can accept tokens from any other user on the network, right?
That's not correct for the tokens we issue. They're only transferable to whitelisted wallets.
So you put controls to protect against what we're talking about here?
We do, correct. Yeah, this is totally possible on a public distributed blockchain, and saying that, providing AML controls or KYC, et cetera, on a public distributed blockchain is not possible. It's like saying it's not possible to run financial transactions.
Okay, well, help me out then, because almost immediately after that money market fund was deployed, internet trolls found the wallet addresses, they sent meme coins, they sent NFTs, tainted funds from Tornado Cash, who of course has been sanctioned by the Treasury Department for money laundering. There were more than 100 cryptocurrencies that were mixed up in legitimate funds that BlackRock had access to. How is that possibly compliant?
So first, those meme coins and sanctioned tokens were not sent to a BlackRock wallet at all. It was sent to some other wallet that was, labeled with BlackRock. So there was a misperception in the press about what happened. Second, the fact that somebody can send you a meme coin to your wallet, it doesn't mean that the token that represents the unit of the money market fund, which is a security, can be freely sent to some other wallet. Or
are you suggesting there's a technical solution to this, or that we will have to actually have individuals in the loop?
Technical solutions. There's other blockchains that prevent assets to be sent to a wallet unless the asset has been pre-approved, and that's something that could be built on top of a public permissionless network without no problem.
Well, I'm fundamentally dubious that you can take the human out of the loop, but I guess in the 20 seconds I've left, do any of you believe that a blockchain system that allows mixers and anonymous wallets can provide a robust ledger of all the transactions and block anti-money laundering?
I do believe so, the same way the internet is also used for legal things and illegal things, and it's a public distributed infrastructure.
I think the industry would be a lot more credible if they were fighting harder before the enforcement actions to protect against money laundering.
Gentlemen,
could you provide some clarity about how this might assist some of the smaller financial institutions in our country, which are absolutely essential, in particular for small businesses?
Congressman, thank you for the question. I think this is a critically important aspect of DLT blockchain, is the ability to help multiple institutions work together in real time to punch above their weight. So traditional technology applications have to be sort of spread across a wide customer base so larger banks can have an advantage in adoption. What's unique about DLT is it's that shared infrastructure that can allow for real-time collaboration. So a group of 4 or 5 community banks might be able to band together to make a loan they otherwise wouldn't.
And is that also true in particular as we think about some of these smaller businesses that maybe is exporting a product? So a business in southeast Wisconsin and Janesville, and they export a product, say, to Italy, and they're looking to receive payment. In the current structure, that if they bank with a community bank, there's a delay before that payment would make it all the way through to their account, right?
That's right, and we think...
And then how does this transform with a tokenization? It could be instantaneous, correct?
That's right. What DLT can do is bring all of those parties to that multi-party transaction together on the same ledger, provide real-time transparency through the transaction so that customer can have real-time insight into how quickly the funds will move, what it will cost them, and when it's received.
I'd like to discuss kind of the benefit that BlackRock is seeing in particular as it relates to the tokenization of money market funds. Could you just comment on the benefit side of it?
Yeah, I can speak on behalf of BlackRock, but I can talk generally what the benefits of a tokenized fund is. First, it's fully transparent in terms of the holdings of the fund. It's transferable peer-to-peer. In the case of the tokenized fund that we've done with BlackRock, it's also fully transferable into USDC, which is one of the existing stable coins, so you get 24/7 instant kind of.
And so you have all those benefits, and then just real quick, because I think you were going to explain more further, or you were explaining how you can actually put in place the controls that we all want, know your customer, et cetera.
Right.
Can you just comment on you in the final 20 seconds here?
Yeah, I think saying that a public distributed blockchain, a permissionless one, you cannot control KYC, AML, or transfer restrictions is a profound misunderstanding of how the technology works. We are a regulated entity, as I've said in my statement, and we do control KYC for the wallets, we whitelist them on chain, we control transfer restrictions using smart contracts, etc.
Thank you very much. I think that's really important to have on the record. Mr. Chairman, I yield back.
What are the challenges this definition creates with the adoption of tokenized assets in traditional finance?
So, as mentioned earlier, SAB 121 is very broad, the definition of crypto assets. So tokenized securities are recorded on blockchain. They are no different than traditional securities. Tokenized stock or a tokenized bond is still a bond or a stock when it's, whether it's in traditional ledger or a blockchain ledger. But the crypto asset definition potentially encompasses the tokenized security. And so this presents challenges from an accounting perspective and a custody perspective for market participants that would need to comply with SAB 121 until some change is effected on that front. I think it's important to remember tokenization does not change the nature of the asset.
This hearing is adjourned.